StockTargets.
Hello everyone. Today we're going to talk about oil price dynamics. Where is the oil price going? The model I'm showing you is there to help you determine the fair price of oil in the future. As you will see, we have a business model which allows us to determine a fair oil price and make relatively accurate forecast into the future as to where the oil price should be or could be. It is a quite comprehensive business model, but this model needs some monitoring. It needs to follow up on oil production prices and several other macroeconomic elements. The idea here is to determine if the oil price today in September 2012 around $95, $96, is it a fair price? Is it a high price? Is it a low price? It all depends on different measurements, but I will demonstrate here that the price of $95 a barrel is a fair price given today's macroeconomic conditions. The oil price dynamics model, which I'm showing here, is based upon a minimum price, a maximum price, and a fair price. In other words, the oil price fluctuates between a minimum and a maximum, measurable in different ways. In other words, the oil price dynamics model described here is a model which tells us that the oil can move down in price but hit a limit and rebound, or move up in price, hit a ceiling, and drop again. I've added to the graph here a minimum line, the red line, with a price of $58 per barrel. I will explain this right now. Pulling oil out of the ground in the 1960s was something quite cheap. All the cheap oil was very close to the surface, and there's a natural tendency for any oil explorer to go for the easy reserves. Today, going for the reserves is more and more difficult. You have to drill deeper, you have to go offshore, you have to go in remote areas. And also, as you will see, a lot of social costs are attached to the minimum break-even oil price for several developing countries. The red line represents this lower boundary, an aggregate price of the oil companies as we have determined here. It represents the price under which these companies or oil producing countries do not want to have the price of oil unless that would generate a loss. You see in the first column the name of the country, in the second column the oil production in barrels per day, and then production per year, and then the estimated break-even price including social costs in dollars per barrel, and the aggregate of these prices in the right-hand column gives you the total aggregate of $58 per barrel for all these oil exporting countries. Within the list here you can see who is producing at a high cost, social costs included, and who's producing at a low cost, social costs included. What is $58 a barrel? It's the aggregate oil price for private oil companies and national oil companies, price under which they cannot afford to have the oil price unless they will undergo losses. Actually, you can see that Saudi Arabia is a little bit stuck with a high oil price they need to have in order to keep this money being flooded towards their economy. Saudi Arabia has decided to flood the economy with a brand new $130 billion a year. The main reason for it is to keep the population happy following the Arab Spring. You have seen that they have increased quite drastically the social expenses such as education and free healthcare in order to keep the population happy. This goes obviously through an aggregate oil price which they need to have for their economy, which now is around $75 per barrel. Even if producing oil in Saudi Arabia seems quite cheap, they continuously publish numbers around $4 per barrel. The actual total price is much higher, and you see this at the top of the list with social costs included. Producing oil in Saudi Arabia needs to have an oil price about $75 unless the government doesn't have the sufficient income they need. Russia also has a relatively high price, around $70 a barrel. Some countries have a much cheaper price for their oil production. Typically you can see Angola is around $40 a barrel, down at the bottom in green. Nigeria around 38. These countries have a relatively cheap oil production, let's say, environment. Not so many social costs included, even though there are some. If you go further up the list, you see the United States around 48 indeed. North American companies are private companies that pay their taxes. There's no social cost included. But if you move totally to the top of the scale, as we said just before, Saudi Arabia needs to produce their oil or sell it at least at $75 a barrel unless they turn a loss. Huge social costs. The bulk of the income to the Saudi Arabian government comes from oil, and therefore all this money needs to land somehow in the government's pockets. This red line, as you can see historically, is $58 today per barrel. But if you go back in the past, you see it around $20 in 1990, 1995. At that time, producing oil was very cheap. Today it's much more expensive. The red line is the aggregate, which actually shows which oil price oil companies can afford to produce at in order to turn a profit. Following the red line, we see this boundary at $58. We don't see the oil price going below, because below that, oil companies and national oil companies will actually not generate a profit. The characteristics of this red line are numerous, starting with a price at $58 per barrel today as a break-even price. 15 years back, we had a break-even price around $20. And if you go back into the 1960s, we had a break-even price at a few cents, say half a dollar. We're now introducing the blue line into the chart, which is the upper limit of an affordable oil price for the world economy. When the oil price goes above that blue line, it automatically induces a worldwide recession. Now the blue line is an aggregate which has been discovered over time as a macroeconomic measurement, and that is 6% of GDP. You do not want to spend more than 6% of GDP for your energy unless you go into recession. The upper limit in price of $132 is the maximum price affordable by any given country before falling into recession. Macroeconomics indicate that you cannot be paying much more than 6% of GDP unless you're just paying too much in order to get your economy running. Here is a quick calculation of how to determine this blue line, this upper boundary for the oil price. You see US GDP at 15 trillion US dollars. 6% of US GDP is about $900 billion. The US oil consumption per day is 18.6 million barrels per year. That is 6,790 million barrels, or 6.79 billion barrels per year. Today, with an oil price around $95 a barrel, that puts the total oil consumption for the USA at $645 billion, which is 4.3% of GDP. If the oil expenditure at 6% of GDP, that would be an oil price at $132 per barrel. In other words, if the barrel was at $132, the North American bill for oil would be 900 billion, in other words 6% of GDP. We had other recessions over the years, but none of them were induced due to high energy prices. We had the case of 1979 and the case of 2008. .6% of GDP for energy is now a well-known macroeconomic boundary. Those worldwide recessions due to oil prices have happened in the past. We saw it in late 2007, early 2008. The financial crisis followed right after that. We also had this recession in 1979 when the oil prices also went through the roof. And finally, we are adding the green line to the chart, which is the average between the red one and the blue one, giving us a fair price for oil. We have an upper limit for the oil price, we have a lower limit for the oil price, and we have a fair price, which is somewhere in the middle. The fair price for a barrel of oil today is between $95 and $96. This model is an aggregate of macroeconomics, which is mainly the blue line, which is an aggregate of GDP. The model is also an aggregate of microeconomics, indicating the capacity of corporations in the energy field to turn a profit. This model indicates a fair price and boundaries between which the oil can fluctuate a minimum and a maximum. The upper limit in price of $132 is not actually an exact measurement. It's just an example for the United States. All the other countries are somewhere in the same neighborhood. You have to treat this upper line more as a zone and not just a limit. The green line shows us in the future what the fair price should be, and there we can see that inevitably that fair price will be moving up. You have to imagine this lower limit being more of a zone and not exactly a price limit such as $58, but rather a zone which could very well be starting at $70, $75, where the first oil producers will start reducing their oil output. With this price dynamics model, we hope you have a better understanding of oil prices worldwide. Around this fair price, we can have fluctuations. Upward being the fluctuations indicating a scarcity or temporary scarcity of the oil, and therefore the prices go up. If we're below, we're in a relative abundance of oil, prices come down, typically in a recession. With the world population increasing and the oil production or output not increasing, you have actually a relative scarcity of oil worldwide. Every year, the world population is increasing by 80 million people, which is the size of the country like Germany. And every 3 to 4 years, you have then a population increase of about 250 million, if not 300 million, which is the size of the United States of America. All these people will want to consume oil. This relative scarcity is going to push the prices up. Again, all these people wanting to live exactly like the developed countries. I'm thinking of China, India, etc., who all want automobiles, things that most of their parents never had. I'm personally convinced that the oil prices are going to go towards the upper side of the next few months, let's say 12 months. We're going to have a surge in consumption coming mainly from Asia, where most of the population is looking now to have automobiles, which they never had before. This is what you call a min-max model, a minimum and a maximum determining the fair price. We will keep on fine-tuning it. We are convinced that the oil prices will move further and further upwards. More and more is the oil price becoming a rare item, a scarce item, and many psychological events such as oil shortages, wars, tensions with oil producing countries will push the oil price higher above the green line and towards the blue line. To summarize, we have a upper limit for the oil price of $132, a lower limit of $58, and a fair price around $95, $96 today. We will be monitoring this oil price dynamics model for you and keep you posted on new events in the future.
Stock Targets.